He had a degree in physical education. He became the CEO of the fifth most widely held stock in America. And the company he built was sitting on the largest accounting fraud in the history of the United States. This is the story of Bernard Ebbers and the woman who brought him down without ever raising her voice. It was July 21, 2002, a Sunday. The news broke across every television network and every newspaper in America at almost the same moment. WorldCom, the second largest long-distance telephone company in the United States, had filed for bankruptcy. $107 billion in assets. 17,000 employees losing their jobs in a single week. And at the center of it all, a man in cowboy boots who had started his career running motels in rural Mississippi. But the real story, the story that would take years to fully uncover, didn't begin in a boardroom. It began with a woman working alone at 3 in the morning, in a windowless storage room the size of a parking space. Her name was Cynthia Cooper, and she was about to do what no one in corporate America had ever done before, bring down a Fortune 500 company from the inside, without any help from regulators, without any help from the FBI, without any help from anyone outside her own small team of internal auditors. But to understand how this happened, to understand why Bernard Ebbers made the choices he made, you have to go back to the beginning, to a place where the American dream was still alive, and a man with a physical education degree and a pair of cowboy boots believed he could build an empire. In 1983, Bernard Ebbers was 32 years old. He was running a small chain of motels in Mississippi, the kind of place where the parking lot had more potholes than cars and the front desk had a bell that hadn't worked in years. He also ran a small chain of gyms. He had no background in telecommunications. He had no background in accounting. He had no background in anything that would suggest he was about to build one of the largest companies in American history. What Bernard Ebbers had was an instinct for acquisition, an appetite for risk that his own board of directors would later admit, under oath, they never fully understood. Started small. A tiny long-distance reseller called LDDS, Long Distance Discount Service. The company was so small that when Ebbers first walked through its doors, it had fewer employees than a single McDonald's shift. But Ebbers saw something nobody else saw. He saw that the telecommunications industry was about to explode, that the deregulation of phone service in the 1980s was going to create the biggest land grab in American business since the railroads. And he was right. Over the next 15 years, through a relentless string of mergers and acquisitions, more than 60 of them, Ebbers turned that tiny reseller into WorldCom. By the late 1990s, WorldCom was the second largest long-distance telephone provider in the United States. The crown jewel came in 1998, the acquisition of MCI for $47 billion. $47 billion. At its peak, WorldCom's market value touched $175 billion. To put that in perspective, that was more than the gross domestic product of several countries. And Bernard Ebbers became a legend. He wore cowboy boots to the office, real ones, scuffed, broken in, the kind you'd see on a ranch in Texas, not in a boardroom on Wall Street. He drove a pickup truck, not a limousine, not a town car, a pickup truck. Employees called him the telecom cowboy. Wall Street called him a genius. And for Mississippi, a state with one of the lowest median incomes in the entire country, WorldCom was more than a company. It was a point of pride. The one Fortune 500 company that called Mississippi home. People who lived their entire lives in small towns across that state invested their retirement savings in WorldCom stock. Not because they understood the financials, but because it was theirs. It was from their state. It was their cowboy on Wall Street. But there was something most people outside the company never saw. Something that would, years later, turn a business problem into a criminal conspiracy. Bernard Ebbers was personally broke. Not in the way you or I might be broke, struggling to pay rent or worrying about groceries. He was broke in the way that only billionaires can be broke. Leveraged to the hilt, drowning in personal debt. Every dollar he had borrowed against the value of his own company's stock. Regulatory filings would later confirm what employees had suspected for years. A personal line of credit from WorldCom worth $408 million. $408 million. And the collateral for all of it, every loan, every margin call, every personal debt, was the same thing, WorldCom stock. As long as the stock price stayed high, those loans were safe. If the stock fell far enough, Bernard Ebbers would face margin calls he could not cover. His entire personal fortune, every dollar he had, existed on paper, propped up by a stock price that he himself was responsible for maintaining. Think about that for a moment. The CEO of a Fortune 500 company needed his own stock price to stay high, not just for his shareholders, not just for Wall Street, but to avoid personal financial ruin. That is not a business problem. That is a ticking bomb. In March of 2000, the dot-com bubble collapsed. Over $6 trillion in market value evaporated in a matter of months. Companies that had been worth billions on Monday were worth nothing by Friday. Internet startups, the very customers that had fueled WorldCom's explosive growth, disappeared almost overnight. The ones that didn't disappear slashed their spending to survive. And WorldCom's revenue, the revenue that Wall Street expected to keep climbing quarter after quarter, simply stopped. For most CEOs, this would have been a crisis. For Bernard Ebbers, it was something far worse. As WorldCom's stock price began to weaken, dropping from $64 a share to $40, then to $20, then lower, his personal fortune, built entirely on borrowed money secured by that stock, was the first thing at risk. Every dollar the stock fell added millions to his personal debt. Every percentage point drop brought him closer to a margin call that would wipe him out completely. According to the report later filed with WorldCom's bankruptcy court, a report that took investigators over a year to compile. It was precisely during this period of maximum personal financial pressure that the fraud accelerated. The internal investigation would conclude, in language so carefully chosen it almost hides the horror of what it describes, that Ebbers directed enormous energy toward protecting his personal financial empire, with little regard for the risk this created for the company itself. Translation: a man who was supposed to be protecting the interests of his shareholders, his employees, and the hundreds of thousands of small investors who had trusted him with their savings, was actually protecting himself. And the mechanism he used to do it was almost absurdly simple. WorldCom paid enormous fees to lease network capacity from other telecom companies. These were called line costs. The payments WorldCom made to other companies to use their fiber optic cables, their switching stations, their infrastructure. In accounting terms, these were ordinary operating expenses, the kind that reduce a company's profit the same quarter they're paid. Think of it like renting a car. If you rent a car for a week, that's an expense. You pay for the use of the car, and when the week is over, you give the car back. You don't get to pretend you bought the car. But that is exactly what WorldCom did. Starting around 1999, under direct instruction from Chief Financial Officer Scott Sullivan, WorldCom's accounting team began reclassifying billions of dollars of these ordinary operating expenses as capital investments instead. As if leasing a phone line for one quarter was the same as building a factory that would last for decades. On paper, and only on paper, this single accounting trick transformed enormous losses into reported profits. It was like taking your monthly rent payment and calling it a mortgage. The money was still leaving the building, but now the accounting books made it look like an investment instead of a cost. In the first quarter of 2002 alone, just one quarter, internal auditors later calculated that without these fraudulent entries, WorldCom's reported $130 million profit would have actually been a $395 million loss, a swing of more than $500 million. In a single quarter, between 1999 and 2002, this scheme inflated WorldCom's earnings by more than $11 billion. $11 billion. And nobody outside a small circle of executives knew it was happening. Nobody. Except a woman who worked 2 floors below the CFO's office, who had started asking questions that nobody wanted her to ask. Cynthia Cooper was the vice president of internal audit at WorldCom. She had grown up in Clinton, Mississippi, the same small town where WorldCom's headquarters sat. Her parents still lived there. Many of her neighbors had invested their savings in WorldCom stock, proud that their state finally had a Fortune 500 company to call their own. She was not a dramatic person. She was not a crusader. She was an accountant, a meticulous, precise, methodical accountant who believed that numbers should add up, and when they didn't, that someone needed to find out why. In the spring of 2002, an internal audit manager brought Cooper a tip, a complaint from an employee about strange spending patterns inside the company's network division. The complaint was vague, the kind of thing that most companies would file away and forget. But Cooper made a decision that would change everything. She moved up the timeline of a routine audit, not because she suspected fraud, not yet, but because the numbers didn't make sense. And in Cynthia Cooper's world, numbers that don't make sense are the only warning you get before something terrible happens. What her team found when they began digging made no sense at all. A corporate finance director told them the discrepancies were related to something called prepaid capacity, a term Cooper had never encountered in all her years of accounting. She asked for documentation. She was told the documentation was confidential. She asked again. She was told the CFO would handle it. When she pushed harder, when she insisted on seeing the actual entries, the actual journal records, the actual numbers behind the word prepaid capacity, something changed. CFO Scott Sullivan emailed her directly. He called the audit a waste of resources. He said it was tying up employees who were needed elsewhere. He tracked her down outside the office, in hallways, in parking lots, in places where you don't accidentally run into someone, to confront her about the investigation. He asked her to stop. He asked her to delay. He asked her to wait until the next financial quarter. And Cynthia Cooper did something that almost no one in corporate America ever does. She said no. She didn't say no loudly. She didn't say no dramatically. She didn't go to the press. She didn't call a lawyer. She didn't stage a confrontation. She simply kept working. Her team began working at night, specifically, deliberately, to avoid the spike in server activity that might tip off the finance department to what they were extracting. One member of her team, a man named Gene Morse, worked out of a 12 by 12 windowless storage room in the WorldCom basement. He bought his own CD burner, with his own money, not a company purchase, his own money. He did it because he wanted to make sure that if anyone tried to destroy the evidence on the company's servers, a copy would already exist somewhere else, somewhere that no one in the executive suite could reach. On June 10, 2002, working through the night, working in silence, working while the rest of the company slept, Cooper's team found the pattern. Enormous transfers of money moving from the income statement to the balance sheet, quarter after quarter after quarter, with no legitimate accounting basis. It wasn't a single mistake. It wasn't a rounding error. It wasn't a miscalculation. It was systematic. It was deliberate. And it had been going on for years. When Sullivan realized how far the investigation had progressed, when he understood that Cooper had found the entries, that she had the evidence, that she was not going to stop, he asked her one final time to delay the investigation until the next financial quarter. She refused. Cooper and her colleague brought their findings directly to the chairman of the company's audit committee, the board member responsible for financial oversight. The board ordered Sullivan to resign. He refused. They fired him. On June 25, 2002, 23 days after Cooper's team found the pattern in that windowless storage room, WorldCom told the world what its own internal auditors had found. The company had overstated its income by $3.8 billion. It was, at that moment, the largest accounting fraud in American history. Further investigation would later push that number past $11 billion. 3 days after the disclosure, WorldCom cut 17,000 jobs. 17,000 people in a single week in a single state. The company's stock, which had once traded near $64 a share, became worthless. People who had worked at the company for 20 years lost their jobs and their retirement savings in the same week. Pensions evaporated. 401k plans that had been heavily invested in WorldCom stock, because the company encouraged it, because employees believed in it, because it was their state's pride, went to zero. People Cynthia Cooper had known for years, neighbors, colleagues, people whose children she had watched grow up, lost everything. She could hear it in the hallways. She could see it in the parking lot, cars that had been there every day for years, suddenly gone. She could feel it in the silence, the sound of a building emptying out, floor by floor, desk by desk. Bernard Ebbers told Congress, under oath on national television with the eyes of the country on him, that he had no knowledge of the fraudulent entries. He said the scheme was engineered entirely by Scott Sullivan. He invoked his Fifth Amendment right and refused to answer further questions from lawmakers. He walked out of the hearing room in his cowboy boots and said nothing. But Scott Sullivan, the man Ebbers blamed for everything, made a different choice. Facing his own charges, his own potential prison sentence, his own ruin, Sullivan pleaded guilty to securities fraud and conspiracy. And he agreed to testify against the man who had built the company around him. The man who had pressured him, relentlessly, to hit financial targets that no longer reflected reality. The man who had been told directly, specifically, in terms that left no room for misunderstanding, how those targets were being achieved. In 2005, the case went to a federal jury. The trial lasted 6 weeks. Sullivan's testimony was central to the prosecution's case. Not just because he had been the CFO, not just because he had executed the fraud, but because he described a pattern of behavior that the jury could recognize. A CEO who demanded results. A CEO who didn't ask how those results were achieved. A CEO who created an environment where the only thing that mattered was the number, not how you got there. The jury found Bernard Ebbers guilty on all 9 counts. Conspiracy. Securities fraud. Filing false statements with regulators. All 9. The trial judge, a man who had presided over dozens of corporate fraud cases in his career, stated plainly, for the record, that the evidence showed Ebbers had been a leader of the criminal activity. Not a bystander. Not a CEO who was too busy to notice what his executives were doing. A leader. He was sentenced to 25 years in federal prison. He was 65 years old. When he walked into that prison, he left behind a world that had once called him a genius. A world that had written profiles about him, that had invited him to speak at conferences, that had bought his stock and trusted his judgment. Outside the courthouse, his own lawyer called it, simply, not a happy day. Scott Sullivan, the man who cooperated with prosecutors, who testified against his own boss, who told the truth when the truth was the most expensive thing he could offer, received 5 years. He served 4. WorldCom's controller and another senior accountant who had carried out the fraudulent entries each served roughly a year. The people who made the smallest decisions served the least time. The man who made the biggest decision served the longest. Bernard Ebbers served 13 years of his 25-year sentence. In December 2019, citing his declining health, citing the fact that a 78-year-old man in a federal prison hospital was no longer the same person who had built WorldCom, he was released to home confinement. He died 2 months later, in February 2020, at the age of 78. He maintained his innocence until the end. Until his last breath, he said he didn't know. Until his last breath, he said Sullivan did it. Until his last breath, he never once said the words that Cynthia Cooper, and the thousands of WorldCom employees who lost their savings, deserved to hear. Cynthia Cooper left the company after the bankruptcy. She didn't stay for the trial. She didn't seek the spotlight. She didn't write a press release or give a victory speech. She quietly packed up her office, walked out of the building she had entered 1,000 times before, and drove home. She later wrote a book about the investigation. She called it Extraordinary Circumstances. In it, she wrote something that every single person who has ever been tempted to cross a line, any line in business, in life, in the quiet moments when no one is watching, should read. She wrote that the story was, in the end, about human nature, about how power and money can change people, about how easily a person can rationalize one small wrong decision into a much larger one, not by deciding to be bad, but simply by refusing to stop, by deciding that the next quarter matters more than the truth, by deciding that the stock price matters more than the people who trusted you with their savings, by deciding that your personal financial survival matters more than the 17,000 people who are about to lose their jobs. In 2002, Time magazine named Cynthia Cooper one of 3 persons of the year, alongside the whistleblowers who exposed the Enron scandal that same year. She was the first internal auditor in history to receive that honor. And the collapse she exposed, the fraud she uncovered in a windowless storage room at 3 in the morning, did something that no amount of regulation had been able to do before. Changed the law. WorldCom's collapse helped trigger the passage of the Sarbanes-Oxley Act. A sweeping reform of how American companies are required to report their finances. It was designed specifically to make a fraud like this one harder to hide and harder to get away with. Every public company in America today operates under rules that exist, in part, because a woman in Mississippi refused to stop asking questions when the most powerful men in her company told her to. Bernard Ebbers built an empire on debt, acquisitions, and a decade of relentless growth. When that growth stopped, he had a choice. He could have told the truth. He could have told Wall Street that the numbers weren't there anymore, that the bubble had burst, that the revenue had dried up, that the party was over. It would have been painful. The stock would have fallen. He would have lost money, a lot of money. But the people who trusted him, the 17,000 employees, the small investors in Mississippi, the pensioners, the neighbors, they would have had a chance to prepare. Instead, he chose the accounting trick. He chose the lie that protected his personal fortune at the expense of everyone else's. And the woman who caught him didn't need a badge or a subpoena or a team of FBI agents. She needed a laptop, a CD burner bought with her own money, and the courage to keep working when the most powerful executives in her company told her to stop. That is karma. Not the mystical kind, not the universe balancing some cosmic scale. The real kind. The kind that arrives when one person, in a small room at 3 in the morning, decides that the truth matters more than the consequences of telling it. Before you go, if the story hit you, drop a number from 1 to 10 in the comments. 1 if it left you cold. 10 if it made you think differently about the next time someone tells you the numbers are fine. Subscribe if you want to hear what happens next episode, because the next story we're covering makes this one look like a parking ticket. And trust me, you don't want to miss it. This has been Financial Karma, and if the story moved you, subscribe to Karma Unleashed. Every episode, we follow the money and the consequences that never stop arriving. Next, another name, another empire, another fall. The history of financial karma is far from over. We will see you on the other side.